Welcome to the Trusted Podcast. As always, we've got some great guests today, and we are going to be talking about being your own banker, the infinite banking concept. And I've got Anthony and Cameron on the show. Guys, welcome.
It is good to be here. Thanks for inviting us.
Absolutely. Thanks, Blake.
Yeah, so I've known both these guys for a long time. They do things a little bit different than the traditional financial advisor you might see. So I thought it'd be good to get a good different perspective on some things, especially the infinite banking concept. But before we jump into that, why don't you guys give me a little bit of background about yourselves, your company, and what makes you guys qualified as the trusted experts, and why we'd have you on the show.
I'll be my guest.
Well, my name's Anthony Faso, and I'm a recovering CPA. I've been a CPA for over 20 years, and kind of part of my backstory is I had my own firm, and everything I thought was going right till 2008. Right? Not only did I get hurt, not only did my 401k turn into a 201k, right? But working with my tax clients, I realized the devastation this was happening to people. That they did everything that they were told to do. They stayed out of debt. They paid off their house. They maxed out their 401k, and to no fault of their own, the whole world changed. Their net worth got cut in half. They may have lost their job. Everything, we got punched in the gut. Mm-hmm. And that had scared me, because I started analyzing and looking into this. And you know what? There's a crash about every 10 years, right? This was in 08. There was the .com in 2000. There was one in 1990s. There was a Black Monday, you might recall, in the 80s. There's a crash in the 70s. I mean, you go back, there's about one every 10 years. And then I realized, unless I do something different, why would I expect a different result? So I started looking out more selfishly for myself. Like, what can I do to protect my family? And so I started talking to clients that not only didn't get hurt, but that were actually thriving during that time. So I was picking their brains. At this point, I wasn't so focused on what they were investing in. To me, it was more about their mindset. Like, how is your mindset different than following everybody else? What books are you reading? Like, what are some of your goals and you're trying to accomplish? So I started reading a couple books, and probably the two most important one is one you've probably heard of, and one you may not have. The first one is Robert Kiyosaki's Rich Dad Poor Dad, right? He changed my way of thinking. Instead of trying to build that net worth and max out your 401k and not enjoy your money until you're in your 60s, he said, let's start creating passive income now. Mm-hmm. So my goal now is not to build a high net worth, is to create passive income that's more than my expenses. And I want to be able to enjoy my time. I have kids, and soon I'm going to have grandkids. I want to be present with them now. And so the second book was Becoming Your Own Banker by R. Nelson Nash. And I kind of incorporated these two books into my daily life and what I was doing with my finances. And then my clients were like, hey, Anthony, I don't trust the stock market. I don't trust financial planners. What do I do with the money? So I just started teaching them, look, read these books. This is what I'm doing. If you would like to, follow it. So then I started teaching them these concepts, and then eventually I sold my CPA firm, and now I'm just teaching this infinite banking concept to my clients.
And I'm Cameron Christensen, and my story, how I got started, was I was actually a small business owner. I moved from Idaho, moved down to Las Vegas, and started a business about 6 months after moving down here. And I had a successful business. I was a small business, so it was just me. And I started looking at retirement options for myself. And a lot of the programs that I was being pitched really, in my opinion, were really more geared towards employees. And that never made sense to me, right? As a small business owner, capital and having access to cash was really my number one priority. And a lot of the advice that I had was, hey, go put your money over here. And at the end of the day, I'm locking my money up until I'm 60, 65 years old. And that never set well with me. And I kept doing research, kept talking to other advisors, and you know what I did? I did nothing. I just sat on cash because I didn't know what to do. And it wasn't until my wife and I were buying our house that our real estate broker actually gave us a book and said, if I would have read this when I was your age, it would have been the difference of millions of dollars. And it was the book that Anthony just referenced, Becoming Your Own Banker. And when I read that book, it was like a light bulb turned on. I can invest my money, have full control over it, and access to it at any time. And so I started implementing some of these strategies right away. And really, how I got into this is I just started sharing the idea with other business owners and said, "Hey, I can probably guess what your number one concern is cash flow. And here's some of the strategies that I've been able to implement that have addressed this." And so that's really how I got started. And you fast forward a couple years later, I met this guy, and we've been good friends for almost 11 years now, and in business together for going on 2.
Okay, awesome. So I'm gonna actually change our outline around a little bit because I think it's gonna make more sense. So let's talk about what infinite banking is and how it works, and then we can talk about the whole life because I think that'll make more sense to people if we go in that order.
Sure.
Perfect. A couple of things to realize about infinite banking is that the infinite banking itself is not an investment. This is a concept. This is a way of thinking. This is a system. And some of the key points here is that we call this like an and asset,
Mhm.
which is going to be unique to many. We're not telling you because we're going to talk about and we're explaining why, but what the financial tool that's used in this is a cash focused life insurance policy. But here's the thing: we're not telling people put your money in life insurance or invest in real estate or your business or your investing. This is an and asset. And the way we design it and the way that you can use it is you can put the money in life insurance and invest in real estate or and invest in your business. So we're not trying to change anything that you're doing, but by following this concept, it can make what you're doing to be much more efficient.
And what I would say is how it works is to understand how it works is you've got to understand why we're doing it. Really, the 2 reasons why we do infinite banking is what we're trying to focus on is never break that compound interest curve. And the other reason that we're doing it is we want to start creating income prior to age 60 or 65. We want to start creating income now today. And so to do that, the how is really broken down into what we say is 4 steps. Number one, what we're going to do is we're going to go out there and we're going to find a mutual insurance company to partner with. And the reason that we want a mutual insurance company is because we want to be part owners of this company. At the end of the year, insurance companies pay out a dividend, and I want a dividend, right? Anthony does too. So we work with mutual companies. The other thing is we want to make sure these companies are financially stable. And so we'll go look and analyze all the ratings that are out there, and we look at all those ratings in addition to the context score. And one of the things that we look at is the loan provisions that come along with these mutual insurance companies. The loan provisions is a very small feature, but it is extremely important on the way that we use these products. So to summarize, step one is we go find a mutual insurance company. Step two is what we're going to do is we're going to start funding an insurance policy. And not just any insurance policy, we're going to design a properly structured cash value life insurance policy. And what I mean by that is essentially we're trying to get as much cash into the policy as we possibly can and still keep it tax-free. And so we're going to minimize the tax benefit. So we can fund this policy on a monthly or an annual basis. Once we start accumulating cash value, we move on to step 3. Step 3 is taking a loan against our cash value. And again, that's really important because we're taking a loan against our cash value, which allows us to continue and never break that compound interest that's happening inside of our policy. And step 3, what we're taking a loan for is usually breaks down into 1 or 2 things. Number 1 is we're going to go pay off some debt, whether that's credit cards or student loans or maybe recapturing a mortgage or some business loans. And by running cash flow policy, taking a loan against it, and then paying off that debt, we've created or we redirect that monthly cash flow that was going to that debt service. The second thing that we take loans against for on the cash value is going to be what I call wealth creation. We're going to go buy an asset that's going to create cash flow on a monthly basis. And what I mean by that is we're going to go take some money, buy an asset, and we've got an income stream that's going to start coming off of that. We're going to use that cash flow to replenish our cash reserves inside our policy. So step 4 is repeat. You go find an asset that creates cash flow and you go and you do it all over again, right? That's why real estate investors are so successful. They find niches that they know and understand better than anybody else, and all they do is they go repeat the process. And so that's what we're going to do with Infinite Banking. So that's how it works.
And I think the key thing of doing this, like in Cameron's example, we paid off debt and or we've created some cash flowing assets. But the key thing is, since we never borrowed from our policy, we just used it as collateral. We borrowed money from the insurance company. What that allows us to do is your cash value in your policy is never touched. So we're continuing that compounding. Even though you're using the money, your money is growing every year.
Yeah, I think there's some great steps in there. I guess the thing I just want to make sure our listeners understand is, look, this is, like you guys said, it's not a product. It is, we call it the infinite banking process because you are becoming your own banker. So when you need money, you take a loan against whatever you have, and you use that money to buy the thing, hopefully an asset, especially under Robert Kiyosaki's definition of an asset. It's not an asset unless it actually puts money in your pocket. And then you put that, you pay off. The biggest thing is you have to pay off your loan for this to work. Yes, you don't have to because you have the collateral there as the insurance, the cash value in your insurance, but the plan doesn't work if you don't actually, or if you're not disciplined enough to actually pay back your debt there. It does need to be, written in, treat it like any other loan, have the terms, pay it back, and so on.
Totally agree. Well said, Blake.
Okay, so tell me why we need a whole life policy for this, and what are the biggest myths that you guys see about whole life insurance?
Oh, let me jump in there if you don't mind. Yeah. So the biggest myth that I would say, number one, is that whole life insurance is a terrible investment. And there is a fundamental misunderstanding when somebody says that or approaches us with that kind of mindset. And what I tell everybody is, this will become clear when you understand what we tell people is words are important. And so if you understand the medium between savings, investing, and speculating, you'll understand why that is one of the biggest misconceptions. So give me a minute. I'm going to go through savings. What we tell our clients is an act. That's the movement of money. Every single month, you're moving money from one account to the next. It's an action. It's a verb. Simply moving money is that act of savings. When you are investing, there's a level of due diligence that goes into that investment that you're moving into. So either you know something, you know something about this asset that most people don't, or you have intimate knowledge of it, or you're just more familiar with it than everybody else, right? So that is investing. There's a very high likelihood that if you do A, B, and B, C is going to happen, right? There's no guesses when you're investing. When you're speculating is when you're putting money into an investment or an opportunity, and you have no control, you have no cash flow, you have no collateral, and the underlying strategy is really just hope. Right? I hope that I hope that there's going to be more money in this when I come back for it in 5 years, 10 years, 20 years, whatever it is. And so when people come to us and they say, hey, this is a terrible investment, we're the first one to tell them that whole life insurance and this strategy using the policy is not the investment. It is the savings vehicle we're putting money into on a monthly basis. If you listen to our podcast, what we're doing is we are discussing or highlighting opportunities for investments. So the money goes into the policy on a monthly basis, and while you're doing your research into what you want to move into as an investment, the money is sitting in the policy. Once you understand how X investment works, then you take a loan against your cash value and you go make that investment. And then the investment, like Blake was saying is the investment makes some sort of cash flow on a monthly basis or annual basis to pay off that interest and replenish the principal. And so that is just an absolute fundamental misunderstanding that I'm glad you asked that, because I hope more people understand.
I would think one of the second biggest myths of whole life insurance is that whole life insurance is expensive.
Yeah.
And I would argue term life insurance is expensive. But let me step back here, and Blake, you even alluded to it, of Robert Kiyosaki, and we are big students of his. And when you do something with your money, it's one of two things: you're buying an asset or you're paying for an expense. And the way he defines them simply is an expense takes money from you, and an asset brings money to you. Okay, with term insurance, I ran an analysis of a 40-year-old who was standard for $1.5 million of term insurance for 20 years. Okay, his premium each year is $2,000 a year. So at the end of 20 years, they spent $40,000. Okay, but at the end of the 20 years, what do they have?
Nothing.
They have nothing. Right? The term insurance ends. So I tell you two things they don't have is they don't have any coverage. Their death benefit's gone, and they don't have the $40,000. That's gone. So to me, that sound, by following Robert Kiyosaki's definition, that's an expense. That's money going away from you. Now, I ran another analysis of, instead of having term, having whole life. And first, the way we design the whole life is very unique. We're designing the whole life not for death benefit. We're designing it for as much cash value as possible. We're actually trying to keep that death benefit as low as possible. Okay? But just to compare apples to apples, I did a whole life policy that had a similar death benefit of $1.5 million. At the end of 20 years, in cash value, there's more. They have $250,000 more than what they put into it. Okay, so they have $250,000 profit compared to a $40,000 loss. Right? Which
and
one?
They still have their insurance.
Exactly. And they still have a death benefit. And what is great about whole life is that you can turn premiums off when you don't want to pay them. And this example, I turned them off after 20 years. And the cash value, that grew by $40,000. And because it's life insurance, they paid zero tax on that. Right? But also, you're here, if you listen, I talk a lot about what's seen and unseen, right? The seen is like the dollar, right? The cash value. But some things that are unseen here is that $240,000 that they had, they didn't pay a dime in income tax, right? And also, they're going to have death benefit when they need it, right? Blake, I know you probably don't know, but have a guess. How many term insurance policies do you believe actually pay a death claim?
I would say less than 2%.
Bingo, right? Right, somewhere around 2% actually pay a death claim, right? But so odds are, if the insurance company is going to give you a policy, odds are you're not going to die, right? These guys are very good using actuarial science. But so odds are you're going to probably live until your 80s. And I know when we're in our 40s or 50s, we don't need death benefit, or we're not going to care about that. But you talk to an 80-year-old, right? They start thinking about their legacy, right? They want to leave something to their kids. And how many people do we know who are 80 years old and ran out of money? Right? It's because they're invested, they're speculating. But here we can ensure the family has coverage, but also we're we're going to have $250,000 more. And you actually said a two-part question, Blake. One is why we use life insurance. And if you read, again, this is a concept. Becoming your own banker, you do not need to use life insurance. You could use a checking account. You could use a CD. You can use an investment account, right? The most important thing is that you're being a good steward of your money. The financial tool is not as important. However, you analyze these different financial products, and whole life is hands down the best product. And the reason being, particularly because there's other types of life insurance, you may have heard of index universal life or variable universal life, like IUL, VUL. All of those are tied to the stock market, so they can go up and they can go down. With our view to use infinite banking, we need a secure money source, one that's going to be certain, one that we know is going to be there. It's not sexy, right? We don't have these home runs, but you know what? It's not going down. Like, it never goes down. I'm trying to tell people, boring is the new sexy.
That's coming from a CPA.
Yeah, it's coming from a recovering CPA. So, but we got to start thinking not of hitting these home runs. What we want to hit are singles, right? Singles aren't sexy, but you're at bat for 3 times, the bases are loaded. You have no runs, but now every time you hit a single, a run's coming in, right? So that's what our clients are doing, to have that philosophy. We're not trying to hit a home run every time. What we're trying to do is never strike out and always get on base.
Right. I think it comes back to the point that, this is the savings vehicle. It's not meant to be the investment portion of it. So yeah, for when you're saving, you want that secure, then you use the other money to go out and get, start your business, rent, buy real estate, whatever that is. So I guess that leads me to my next question with, how does this work with real estate investing? How does somebody use this to go out and buy rental properties?
Infinite banking. The reason why Nelson called it infinite, because there's infinite ways to use this. Right? This can be, like Cameron had mentioned, to pay for expenses or to pay for debt. But it's a heck of a lot cooler when you're buying an asset, right? Of creating that cash flow. Now, with real estate, you're buying real estate, you're either going to pay cash, or ideally we'd actually recommend potentially getting a 30-year fixed mortgage if you can, because the interest rates are so low and it's fixed. But even if you have a mortgage, you're going to have to come out with a down payment. So when you're buying real estate, some cash is coming out of your pocket. Either you're paying for the whole thing, or you're just paying for the down payment. And this works really well with that down payment. One of the pillars that Nelson Nash talked about is you finance everything you purchase, meaning you either pay cash and give up interest, or you use credit and you pay interest. So either you pay up or give up, right? It's one way or the other. But by becoming your own bank, right, we can get the luxury of having both, right? Because what we're going to do is we're going to leverage against our policy, right? Because what normal people will do, they want to buy an asset. Okay, they're going to save up money, and then when they have enough of the asset, they buy the asset and drain their account, and then they want to buy another asset. Okay, so let's start saving. And then when we have enough, we drain our account. Problem is, we're continually breaking the compound interest curve. But by using infinite banking as that source for the down payment, as Cameron had explained, we're never breaking the compound interest curve. And I know what a lot of people think is, well, okay, I take that policy loan, but I need to pay myself back, right? So a lot of times people will say, well, you know what? It would be better for me just to pay cash, so I don't have to repay the policy loan. And if you look at the big picture, people are missing it because we got to look at what's happening in our policy. Whatever we use for the down payment, that's continuing to grow. We have to account for that compound interest. And we've actually done a podcast along with a video going through the numbers. And we run an analysis. Let's buy one house straight up cash. And then let's buy another, and we'd have no repayment back to ourselves. And then we buy that same house with the infinite banking concept. And we're accounting for repaying that amount back to our policy. Now, when you look at all the characters in the play, to me, whoever is the winner is going to have more cash. And we've ran the numbers, and I'm going to give away the answer, okay? But I'd still recommend you watching the video. Because of the continuing compounding, we're going to have more money using infinite banking than paying cash.
I'll jump in there and add one little story there to that is we often work with a lot of real estate investors, just right. They don't use typical retirement accounts, so they sit on cash. And a lot of times they come in and they look at us and they're like, you know what? I can go get a better rate of return if I put my cash into X investment. So we're like, all right, yeah, we get that. You just tell us kind of what you're doing, and we'll make a comparison for you. So we've got one that we put together where he comes in and he says, hey, the cash that I'm using to go make these investments, and I plan on doing that over the next 20 years. And so we ran his scenario using cash. And then what we did is we just came in and had to run that same dollars through policies. Didn't change cash flow, didn't change the returns on investments at all, same thing. And they got handed up with an extra $1 million at the end of the day, simply by changing where the money is held as opposed to a savings account versus an insurance policy that's designed for cash value. And we call that the $1 million mistake. And so we'll make sure that we'll share that video in the show notes today.
Yeah, I think another thing that I really like is if you're getting an asset that's actually producing income, that becomes a business, and it can borrow against your cash value, and then because you're repaying, the business is repaying a loan, that's interest that it gets to deduct on its tax return as well. So you have tax savings as well. You have the business stuff that you get to create your LLC, and you can write off a lot more stuff. So even if you're not you're a W-2 employee, you create opportunities for yourself to have some significant tax savings as well. And I don't think those always get factored into the numbers as well.
And as you mentioned, there's a lot of great tax advantages of real estate. There's the depreciation. Right? You can deduct that against ordinary income, right? And then there's capital gains when you sell it. Great tax advantages of real estate. There's also a lot of advantages of life insurance. Not only is it tax-free and liquid, depending on the state, like in Nevada, 100% of your cash value is asset protected. So from lawsuits. So you take the tax advantages of real estate and you couple them with the advantages of life insurance, and that's where you're truly maximizing the tax code.
All right, this question's coming since I'm an estate planning attorney. How does your infinite banking concept work with relation to people's estate plans and their trusts?
Great question, Blake. I'm going to jump in here on this one. So when you ask that question, essentially what is estate planning? Estate planning is the transfer of wealth from one generation to the next. And our emphasis is, my next question for that would be, what is wealth? Right? And what we tell clients is wealth is not just dollars, but it's also cents. That's Anthony's saying, so I want to give him credit. But I love that saying is because infinite banking, this is a concept. And this concept is the conduit to teach one generation how money actually works. And what I've seen as far as estate planning goes is typically what's happening is that, mom and dad will typically have money if they have it, is they're giving it to kids. And what they're teaching them when they're giving money to kids or a younger generation is they're teaching them that mom and dad have money and you can have access to it anytime you want to.
Mom and dad are their bank. They don't need their own bank.
Exactly. And so one of the things that we teach about in here is, hey, listen, we need to redefine kind of what this whole thing looks like, the understanding of kind of family unit's idea of wealth. Because if mom and dad have money, it's not theirs to give to me. Right? Our family has wealth. And so the thing that we need to teach them is we need to teach them stewardship. And we need to start talking to them in terms of lending and say, hey, listen, if we have a nest egg of money, is what we should be talking to the kids about is A, we should be having a conversation because it's not always being had.
Mm-hmm.
But B is, hey, if there's an opportunity where the kids need money, let's talk about lending it to them. And now what we're teaching them is that mom and dad have money and you can have access to it as long as you put back in more than you took out. And now what you have is this continuing perpetual growing of wealth and the estate. And again, you're teaching them the concept, teaching them stewardship. It's not just handing out money. And so that is probably the biggest takeaway that I see as far as estate planning goes. Is most of the time that estate planning, in my opinion, is right. Is we're putting in place vehicles or structure to remove access to for certain family members, and whether it's incentive trusts or kind of a certain age barrier that you put in place is a restriction there. And in my opinion, they're restricting money from that generation because they don't feel like they are responsible, that they don't feel like they're going to be a good steward of the money. And I'm going to take full responsibility for that with my family. And my kids are 10 and 6. And I've been talking to them about money and how money works for a while now. And one of the best resources, if anybody's listening has young kids, that I can recommend is the Tuttle Twins book series on money and finance and free markets. It is a great book series. I've got all 3 of my kids reading it, and I've got the older 2 that are doing reports on it. And so they'll read the book and they'll come in and they'll do a video report. My son stands in front of me and I ask him 5 discussion questions. And he reads them back to me. And then my daughter, she's 8, she will read the book, and she is a little more reserved. She wants to write her report. And so that is a way of having the conversation. They're still a little bit too young to really be lending money, but I'm a big proponent for starting small, right? So when I get there, is my kids are going to get up, and when they get 15 to 20 years old, I plan on lending my kids money. And the reason I do that is because I want to see if they fail. I want to give my kids an opportunity to fail. While I'm here able to come up alongside and put my arm around them and say, hey, what kind of mistakes did we make here? And what I see with estate planning is nobody has that conversation. They push it off. Then people end up passing away, and there's this big windfall in somebody's life. And they could be 40, 50 years old with that windfall, but they still have no idea how money works. So,
I agree. I see it all the time as well. I like that book series too, by the way. My oldest has read it. My younger one can't read yet, but when he can, he will be reading those books as well.
Like what Cameron said, most of the time we're not teaching the next generation about money. Maybe if we're lucky, you're out of college, so you should max out your 401k, your IRA, right? But there's really no guidance there. It's just give your money to Wall Street and, let's hope it's there. What we want to challenge our clients, that we need to educate our clients now while we're still here. And like what I've done with my kids, I created their own policies for them about 10 years ago. I will say I had funded a 529 plan, and in 2008, my son lost 50%. He's lucky because my daughter lost 60, right? But my son was going to go to college in 2 years. So I couldn't wait, for the money to come back like he said it was going to be. I need it to be safe because I'm going to spend it here in a couple of years. So what we did is we set up our own IBC policy for the kids. That's how we financed their education. And so now, like when my son, he's graduated, now I've had him read the book and I'm explaining him the infinite banking. And now I'm having him pay the premiums. I still own it and control it. But now that he's taught, that he's shown me that he can pay the premiums, he's borrowed money. In fact, we started a family business, and both kids took policy loans to capitalize the business. And with my daughter, she's buying her first rental property. She's a senior in college, and I'm doing 99% of the work. right? But what I'm trying to set her up. Okay, I'm teaching her how to use this policy, teaching her how to create passive income. And the goal will be is I'm going to be by her side and I'm going to teach her what I'm doing. And I'm going to push her to do things that she wants. And I'm going to guide her to buy real estate or start a business. But I teach them to use that policy. So it's kind of like the scenario about, you could give your kids a fish so they can eat, but we want to teach our kids to fish because I want my son to teach my grandson. This is going to be part of my legacy. It's not all about the dollars. It's about the sense, like the common sense.
Yeah, that's definitely true. The one thing I was going to add to that is, make sure, especially if you have policies on your kids or if you own a policy on your spouse, that needs to be actually owned by your trust, because you're going to run into problems with probate. People think, typical life insurance is I buy a policy on myself, so when I die, it doesn't matter that the owner died because I'm also, the insured, so it pays out. But if you own a policy on your kid and you pass away, well, now we have to go through probate to transfer ownership of that policy to the next generation. So we want to make sure we have that owned in the trust. And then that also can restrict, or put guidelines in place of, hey, if you want to take a loan, great. Here's the terms that you're going to loan against and all that, and they can have access to that. So you can set out those wishes, not only in the teaching concepts, but it can be laid out in the document itself. And here in Nevada, that trust can go on for 365 years. So you can create that legacy that will last a very, very long time.
Awesome, great points, Blake.
All right, guys. How can someone find a trusted advisor like yourself that talks about and knows infinite banking concept? What key things should they look for when they're trying to find someone versus a typical life insurance person? And then if any red flags should they stay away from?
Perfect. We've actually created a video on the top 5 questions to ask your IBC agent before you do business with them. Okay. So we will give you that link, but I'll give you the questions to ask. For one, how are they using the infinite banking concept? This strategy is very different. If somebody's doing a bunch of different things, maybe they're doing 401ks and other qualified plans, IRAs in the stock market, I'd recommend you do somebody who's living and breathing this. They need to be practicing this themselves. And what I think is a common question people rarely ask is that they should talk to one of their clients. Because, particularly in this type of strategy, this is going to take a lot more hand-holding, and you're going to be working with your agent a lot more than you do now, with your financial advisor. So everybody's talk smooth when they're trying to sell, right? But what you want to see is how does that person handle after the sell? Talk to a client, right? He told me that he'd be available if I needed him. Is he? Or just ask those questions. Also, what resources they have. Because if you're going to take a loan, well, then if you have a business, you may need corporate minutes. You may need help with the repayment schedule. Who's going to help with the loan? Who's going to help with the guidance in there? They need to have those resources. Also, here's the key thing: is what happens if something happens to the agent, right? Infinite banking is so unique. You need to be working with somebody who understands this. And so, like with us, something happens to me, there's Cameron, and vice versa. And finally, I would say, are you certified? Right? Because Nelson Nash wrote the book in 2000, and a lot of people are taking his book and this strategy and misusing it. They're not following the principles that Nelson had laid out. So what he did to protect the brand is there's a certification, right? So people not only have to pass a test, they need to submit policy design. They need to have a mentor that can sign off that these guys know what they're doing and are doing the right thing. And also, there is a code of conduct that IBC practitioners are here to follow. You can go to infinitebanking.org, and in there you can do a search for any agent. Now, with us, we live in Nevada, but we are licensed to do business everywhere that we need to be. You want to talk about flags?
Sure. Two of them come to mind. You touched on one of them, but I want to reiterate it. Is the biggest red flag is if you're talking to somebody, is ask them if they're implementing or using a strategy, how long they've been doing it. And ask them, what was the last investment? What was the last time you used your policy? How did you structure your loan repayment? What insurance company did you choose and why? Those are some really good questions. And the biggest red flag for myself and for Anthony is going to be if someone is promoting a universal life policy, whether it's IUL, VUL, or just straight UL, along with this concept. We also have a resource page that we've created. We've done the numbers, we've looked at these things, and if somebody is recommending these two ideas along with that type of policy, run away really fast because they don't have a proper understanding of how this thing works. So, two big red flags right there, Blake.
Okay. Well, how can people get a hold of you if they want to reach out, if they have more questions?
Yeah, they can find us. Where we're going to send them is we've got a landing page that's catered specifically to your listeners, and kind of how you had mentioned before on the front end is we're going to have some resources there for you. And so it's going to be infinitewealthconsultants.com/trusted, and that's going to be the landing page. And when you go there, we're actually going to give you access to our online course. Typically, we charge $500 for non-clients, but Blake, because of our relationship, we want to extend that offer to your listeners. And so we'll have a link in there where you guys can jump in, learn a little bit more about the concept, and kind of take the next steps there. What else, Anthony?
Well, we also have a podcast, the Infinite Wealth Podcast. We also do quite a bit on YouTube as well.
Perfect. Yeah, and I'll make sure we get those links out. I appreciate it. It's a very generous offer. Hopefully our listeners take advantage of it because that's definitely some great information in those courses. Thank you guys for being on. I think there's a lot of good information on there. So anything else we missed you feel like is vitally important that we need to talk about?
No, just recently I know you were nominated for an award. Would you like to tell us about that?
Yeah, I just won one of the top transactional probate attorneys in Las Vegas. So there's only 6 of us who made the qualification, so that's pretty cool.
Man,
wow, that's impressive.
Congratulations, Blake. I've known you for a while, and quality work. I send almost all my clients to you to do the estate planning. So he has intimate knowledge of this strategy, and we're big fans of it.
Cool. Appreciate that, guys. Yeah, so listeners, as always, please like and subscribe. So that way you get the latest content. I'll make sure I put up the links so you can find them there. And then always reach out, let us know who you want to see on the show next, who we can have on to make sure that we always keep relevant content on there. And with that, we'll talk to you guys next time.
Take care.